Man, he calls everybody back in and says, "Hey, go out and collect 6 weeks worth of wood just to be safe, so we can get done with this." They did. A few days later, he called back to the weather station and goes, "What's it look like now?" And he said, "Oh man, we're going to have one of the worst winters we've ever had." And the young chief said, "What the heck is wrong with your computer indicators? You can't get anything right." They go, "Oh, we don't use computer indicators. We watch the Indians. The more wood they collect, the colder the winter's going to be. So if you don't know what your indicators are telling you, they don't really do you any good." So the nice thing about candlesticks is it shows us graphic situations. A lot of people say, "Oh, look at the price, look what we did here and look what we did here." I'm not interested in what you did here. I want to know what was here that told me this was going to happen. And that's exactly what candlestick signals do for us. So out of the 50 or 60 signals, there's 12 major signals, and that's just kind of a list. I guess, another thing I should say is don't bother taking notes. We're going to go too fast for taking notes. This is all, information is going to be available and sent out to everybody, so just kind of sit back and let your eyes kind of do the learning. The first major signal that we'll go into a little bit is the Doji. The Doji is where they open and close at the same level during a specific time frame. A small trading range is a Doji star. A long trading range, again, this is the range of trading during the day, and this is the open and close. That's a long-legged doji, a gravestone doji. It looks, or a dragonfly doji. It looks like a dragonfly doji. And the gravestone doji, the Japanese race traders explained it as the warriors going out of camp, going into battle, and by the end of the day, they were beaten back into camp, leaving their dead all over the field. That's the gravestone. And a derivative of the doji is a spinning top, where it has a small body, but it looks like a spinning top. But there's one aspect that's the same in all of these, and that is that that there's indecision between the bulls and the bears, and that's very important. So doji rules, Japanese rice traders have made it very simple for us. If you see a doji at the top, you sell. If you see a doji at the bottom, you need to see bullish confirmation, or the Japanese say the weight of the market could continue to push the market down. Whenever you see a doji, pay heed, because that means there's indecision between the bulls and the bears. But excuse me, here's the one that's going to make you tons of money. And that is the trend will usually move in the direction of how they open the next day after a doji. So, and using candlestick signals and gaps are what produce the big power moves. I've been in the business for 35 years, and I've heard all these money managers say, stay away from gaps because you don't know what's going on. Knowing what's going on in the candlestick signal followed by a gap is very informational. If you see a doji at the top followed by a gap down, that tells you that was the top. Not only are they getting out of this position, they're getting out in a hurry. So one of the most strongest reversal signals is what we call an abandoned baby, is where at the top they gap it up, and this all goes back to the very basic premise of where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. And the nice thing about the candlesticks is it graphically shows you what's going on. I used to be the worst investor in the world, and I did everything that the normal investor did. I was always buying up here and saying, shoot, how come when I bought here and everything looked great, it immediately went the other way? And I was even a stockbroker for 8 years. What I discovered is the Japanese race traders just graphically watch what the graphic depiction is doing. If we see one doji, it means indecision. A series of doji means greater indecision. So they're going to tell you which way they're going to go. And if your stochastics are in the overbought condition, look for the downtrend. Now let me regress here a little bit. My stochastic settings are 12, 3, 3. The moving averages that we have on this chart is the 200 simple moving average, the 50 simple moving average, and the 20 simple moving average. The reason for that is every major money manager in the world uses those moving averages to make decisions about what they're going to do with their portfolio. The nice thing about candlesticks is we can see immediately what the investor sentiment was at those levels. Now here's the most important one. This is what we call the T line. The T line is short for trigger line, and it says one very simple concept. If you see a candlestick buy signal and a close above the T line, you can stay long as you don't see a candlestick sell signal and a close back below the T line. If you see a candlestick sell signal and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. So Doji's at the top, it's time to sell. Doji's at the bottom. Now there's one caveat to the T line, which is the further away you move away from the T line, the 8 exponential moving average, the higher the probability it's going to come back up and test it. So that makes your probabilities of being in the right trade at the right time extremely strong. If your stochastics are in the oversold area and you see a doji followed by bullish confirmation the next day, you want to be a buyer. 1, because that's a reversal signal. 2, look how far away you are from the T line. You know the probabilities are that they're probably going to come back up and test the T line. So if the worst case scenario, you were buying and then they failed here at the T line, you're back out, hopefully flat or with a slight profit. But that would basically have told you the T line was not going to act as, or was acting as resistance. Next day when they go through, you know you can stay long until you see a candlestick sell signal and a close back below the T line. So a doji at the bottom followed by a gap up, that's your best friend. We call that your best friend. Where do most people sell? They panic sell at the bottom. When we start seeing a potential reversal signal, that tells us we want to look for a buy signal. There's a doji gap down after a downtrend. That tells you everybody's sold off. If they gap it up the next day, you want to be a buyer. That tells you not only was there indecision down here, but it's time to go up. I always kept thinking, how come every time I sold down here when everything looked terrible, who the heck was buying? And through the years, I discovered that was the smart money. So now I'm in the mode that if I can see something heading down, getting into the oversold area, I'm waiting for the buy signal to get ready to buy instead of being somebody ready to sell. If you see a gap down in an oversold area, get ready for a reversal or some sort of buy signal. There's your big doji hammer signal in the oversold area. You're buying on a probability that you're now heading in an uptrend. Now, this is just kind of skimming over quite a bit. If you see a doji in a combination with another signal, this is what we call the left-right combo. That's a doji followed by a bullish engulfing signal, which is one of the major signals. But that basically tells you there's a lot of indecision here. And then after that, the indecision, there's a strong decision-making candle. That tells you you're going to have a strong uptrend, and usually a stronger uptrend than normal. And if you see that occur right on a major support level, again, this information is immediate. Somebody was asking me a few weeks ago, how many days does it take for you to confirm that you're in an uptrend? And the answer to that was 0. If we see a candlestick buy signal, we start seeing them trade back up above the T line, we want to be buyers and hold until we see a candlestick sell signal. So we're in there immediately, which does 2 things for us. 1, it gets us in early, and everybody else whose systems are confirming are adding to our profitability. And 2, very simple rule. If you see a candlestick buy signal confirming, you want to be a buyer. If you see a candlestick signal and it fails, meaning the Japanese rice traders have a very simple philosophy. If this was the signal that told you the bulls were taking control, then where should it not close? It shouldn't close more than halfway down the candle that told you the bulls were in control. If that happened, that tells you the bears are still in control. You want to be out of the trade. And this is another nice aspect of candlestick analysis. In the 35 years I've been in the in the investment business, I've heard so many investors tell you, cut your losses short and let your profits run. And in that 35 years, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Candlestick analysis has some very simple common sense elements that help you set up your stop losses and your entry strategies. We're looking for, this is what we call a fry pan bottom, a slow rounding bottom. And notice what we have here at the breakout. A doji, bullish engulfing, left-right combination, breaking out through this level. What's that tell us? It tells us this is wave 1, this is wave 2. we're now buying wave 3. Now, as we go through this, when we see a signal, we'd like to see a reversal signal in the oversold condition. When we see a pattern, we know the pattern is probably going to break out when stochastics are up here in the overbought condition. So we know there's about 5 or 6 very high probability patterns, and there's 12 reversal signals. And if you have that as your arsenal, visually you're going to be able to be in the right trades at the right time with a high degree of probability. What do we want to see here at the top? We want to see it break out, and this is our resistance level. Here's a left-right combo as this fry pan bottom breaks out. What do we expect after a fry pan bottom? A strong price move. Now, our next pattern that we know of is a J-hook pattern, which it pulls back, and we see well before the stochastics get to the oversold area, the buyers step in. This is one of our strong signals. This is what we call a belt hold signal. Notice how it gapped way down away from where it was trading and came right back up into the trading range. That basically tells you all the sellers that were here were kind of wiped out and the bulls took over. That started our next uptrend. This is what we call a classic pattern. Fry pan bottom, strong price move. Pull back, J-hook pattern. If this is wave 1, wave 3 is usually the same magnitude as wave 1. So gaps represent enthusiasm, and if we understand what is going on in investor sentiment based upon a previous signal, it puts us into situations where we can be buying when everybody else is panic selling, or it's time to be out of a position. This is what we call your best friend, and it's also a morning star signal. Stochastics in the oversold area, Doji, followed by a gap up. A close above the T-line. What are we looking for the next day? We're looking for bullish confirmation, which is continued buying. What we don't want to see is an open back down here, because that tells us the bears or the bulls aren't very strong. The bears are still here. We don't want to be entering this trade just yet. So not only do the candlestick signals tell you when there's a reversal, there's some very simple entry strategies that put you into the right position at the right time. And I want to go through the kicker signal, because the kicker signal is one of your strongest signals. It's basically when you've been in a downtrend. The last trade opens here, closes here, last trading day. The next day they gap it up and open it at or above the previous day's open and go the opposite direction. Or if you're in an uptrend, it's moving up, last day, this was usually me, I'm thinking, man, oh man, I'm making enough money, I'm going to buy new golf clubs and buy a new car. The next day they gap it down below the previous day's open. My first thought is, man, if they would just take it up and let me out, I'd be so grateful. But what I discovered is, if you're in an uptrend, they shouldn't be gapping it below the previous day's open. So there's only one thing you do, is you close out the position immediately and get ready to go short. So the bigger this gap up, remember, this is a change of investor sentiment, the higher the probability you're going to be in a very strong uptrend. And if they stay above the T-line, you just stay long until you see a sell signal and a close back up above the T-line, or below the T-line. Anytime you see a doji followed by a gap up, you want to be a buyer immediately, because that told you after the indecision, and it's not unusual to see a flat trading with a doji as the very last day, then they break it one way or the other. And notice what happened here. You kind of had a trend trajectory. All they did here is in this little bobble, they took you right back up to the trend trajectory, strong price move, and did a kind of a 45-degree from there. This is why we can anticipate. Recently we were buying NPSP, both the calls and the stock, because we had the doji gap up. There's your trend direction, and it continued to move up from that level. So the patterns, fry pan bottoms, the dumpling top is the opposite. We have a cradle pattern, a J-hook pattern, a scoop pattern, and a belt hold, and the gaps. Those are the things that make us big money. This one was a while ago. Do we always make buy at 15 bucks and sell out 3 days later at 45? Definitely not. But the candlestick patterns alert us to when this is time to be in it, and it puts us in a situation where the probabilities are extremely strong that we're in a trend. This was our signal right here. Essentially indecisive fry pan bottom, breakout, notice what they did on the pullback. They couldn't close it back below the T-line. This was a buy, this was a buy, and this was a buy, all confirming that we were heading in the right direction. Did we expect it to go here? Heck no. All we knew is it was probably heading higher. So, but again, it comes down to the basic assumption that if you do what the candlestick signals do, which have 400 years of research, you're probably going to be in the right direction at the right time, and you're going to have a much bigger possibility of participating in big price moves. So when we're watching for that big trade setup, we're looking for things that tell us when things could occur, like a fry pan bottom that gaps up through the resistance level. And remember, most of the time we're saying we want to buy when the stochastics are in the oversold area, except we know when a breakout occurs, it's usually going to be when the investor sentiment has built up and they've broken out. This is the results we expect coming out of a fry pan bottom, a very strong price move. We also have situations after a move. There's a lot of truisms in candlestick analysis, which is the further away you move from the T-line, the higher the probability it's going to come back and test it. So it used to be I would hate to take profits because, boy, I'm making good profits, but what if I sold here and it just kept going right up through the roof? Boy, would I look stupid. Well, now at least I can see when the probabilities tell me it's time to take profits, because the further away you are from the T-line, the higher the probability is going to come back to that level. Worst case scenario is that it supports here at the T-line and heads up, does a J-hook. I can always buy back in. So candlestick signals have truism. The Doji rule is basically that the price is going to move in the direction how they open it after a Doji. And if that's occurring right at a resistance level, like right here or right here, that tells us if they're moving positive the next day, that's the direction that they're probably going to be moving. Now, I use this chart to explain how useful candlestick signals are with support and resistance levels. My late friend Dave Elliott from Wall Street Teachers called this a blue ice failure. That's where if somebody's fallen through the ice, they come up trying to find the hole they fell through, they can't find it, which is a candlestick sell signal. They drown. Where are they going to? They're going down to the pond, bottom of the pond, which is down here. Now, I always, when I did presentations around the nation with David, I would step in after he told the blue ice failure, and I would say, how do you catch a polar bear? You cut a big hole in the ice, and then you spread a can of peas around the hole. And when the polar bear comes down to take a pea, you kick him in the ice hole. It didn't have anything really to do with investing, but it made him remember the blue ice failure. But notice what happened here. We had a big Doji, morning star signal, bullish confirmation. Where is it going to? Back up to the 50. Fails at the 50 with a bearish engulfing signal. Where is it heading to? Probably back down to the 200, except we have a morning star signal that tells us they're taking it back up. And notice where they closed it, above the T-line. Then this becomes our next analysis, the T-line crunch, where the T-line, they can't close anything below the T-line, and the T-line keeps pushing it back up into the resistance level. Makes this very simple. Another day of indecision right here at the T-line crunch. It's very easy that if we see that the pre-market futures the next day are telling us the market's opening positive, we can be buying immediately because that tells us this level, the second time it's approached, is not acting as resistance. They're going through. So it makes trend analysis very simple. So we watch what happens at the resistance levels. Here we've had a gap up, your best friend, kind of a flutter kicker. A flutter kicker is where you have a down day, a Doji, and then a bullish day. If you took this Doji out of here, you have a kicker, which is a very strong signal, which means we've got a strong move, a fry pan bottom, looking to see what happens once it breaks out through this level right here. It just kind of gives you a roadmap. Again, that's where that resistance level is broken. Very strong price move to the upside. The kicker signal will produce these very strong uptrends. The Doji followed by a gap up. This is what we call your best friend, because anytime you see a Doji, especially toward the oversold area, followed by a gap up, there is a very strong probability you're going to be in not only an uptrend, but a strong uptrend. So the breakout areas are basically your resistance levels, whether it's the moving averages or a resistance area that you can see on the chart. And that just gives us the insight to say, all right, there's something new happening here. We want to be buying. Again, do we always get these huge moves? Definitely not. But it puts us in the situations where the probabilities are in our favor, that if we're seeing a breakout of a pattern, and a breakout usually is a big candle or a gap up, that tells us we want to be buying. Even though we're in the overbought condition, that's telling us we're going to be moving much higher. Now, this one was a very simple trade. We were buying right here on the breakout, couldn't close below the T line. When do we want to take profits? We have a very simple rule in candlesticks. If they start gapping it up, especially in the overbought area, and you're that far away from the T line, basically put your stop at the previous day's open. At worst, if it comes back down through there, that means the bears are in control. You want to be out of the trade. There's also some, if it gaps up, there's also some other techniques we use to take profits up here based upon how it moves after the open. The big percent moves are going to be when they break out of patterns. There's your, what do you call the classic, the fry pan bottom breakout. There's your J-hook pattern. So we know when to take profits, and we know when to get back into a trade. This is what we're looking for, is the candlestick signals. Notice how the T-line is pushing this up. Notice how we have Doji, bullish confirmation. And then they gap it up through this level and go positive. That's telling us that this level is acting as a resistance. This tells me that this is a J-hook pattern. If this is wave 1, wave 3 is going to be equivalent. We also know, let's see, this was BBRY a while back. We know if we have a strong signal, just like we saw a kicker signal here to the upside, it shouldn't gap down and go the other way. So if we were ready to buy based on positive trading here, you definitely did not get in. If you bought based on positive trading, getting into the kicker signal, if you were watching it, the next day if they open it lower, you get out right away. Somebody asked me, what's the percentage of your correct trades versus bad trades? I would guesstimate over the years, I'm probably somewhere around 65, 67, 68% positive, which sounds pretty good, but it also tells you that 1/3 of the trades that I do are negative. But the nice thing, again, about candlestick analysis is it tells you when to get in, and it also tells you when to get out of a trade immediately. So if we're looking for factors to tell us when a strong breakout could occur, we want to analyze what is the market direction, which is easy to do with candlestick analysis. What are the conditions of the stochastics? Is there an obvious resistance level? What signals have price moving toward that breakout? Or what pattern had prices moving through that breakout? So once we know that information, again, here's the Doji rule. We had a belt hold signal, which told us we dried up a lot of the sellers, then a Doji. We have a simple rule. This is what we call a Doji sandwich. If you see a big price move and a Doji with stochastics heading up, the next day they open it positive, simple Doji rule, it's going to move in the direction of how they open it. And there's a high probability that the magnitude of this trading day and the magnitude of this trading day is going to be equivalent. So even for a day trader, seeing this type of setup, knowing that if they open up positive after a Doji, notice all the things that it would be doing on a positive open. Number one, just the fact that it opened positive after a Doji tells us we're going positive. Number two, it would tell us that the T-line is not acting as resistance anymore. Number three, in this case, this downtrending channel is broken. They're going to be heading eventually up to one of the next resistance levels, which would be either the 200 or the 50. So again, this is not rocket science. This is just simple common sense factors that the Japanese race traders have produced for us over 400 years to tell us what happens normally in investor sentiment. There's your left-right combo with a close above the T-line. If it opens positive the next day, which it did, even though it backed off after the open, it was still a breakout through this resistance level. That told us something happened here to confirm our left-right combination. If we can see the scoop pattern, which is usually a flat handle with a scoop, there's our bullish engulfing signal. There's our Doji gap up through the resistance level. That tells us we're going to have more upside. This information works whether you're trading off the daily chart, the hourly chart, or the 1 minute chart. They're all going to be, this is the Dow 1 minute chart. If you're trading the YMs, this tells you when it's time to take profits. This tells you when it's time to buy back in, or a breakout right here. Anytime we can see a resistance level, notice what we had down here, double bottom. We had a bullish Harami, which tells us the selling has stopped. Now we've got a morning star type signal that closed above the T line. Then there's that Doji sandwich right there that closed above this level. That told us we should be buying, even though we were up here in the overbought area, but they had broken out through this level and there was still more upside. So this is where the Doji rule comes into play. If you're at a resistance level and you see a Doji, the simple rule of the Doji is it's going to move in the direction of how they open it. So if they open this positive, they're telling us they're going positive, which means they're breaking through this level. And that tells us we want to be buying immediately when everybody else is wanting to see confirmation that they're breaking through this level. This is once that's broken through, everybody else is jumping in after we're in. The slow curve is kind of a derivative of the fry pan bottom. It usually occurs after an uptrend, pulls back. Notice how this is very slow, indecisive trading. Where's the buy point? Right here. This usually creates very strong breakouts. So if we're buying stock and or calls, we're doing it right in this area because two things are going to happen. If it breaks out, it's usually going to produce a very big price movement for us. If it fails, we're right back out of the trade. Again, there's a left-right combo. If we saw this opening positive the next day, what's it telling us? It's confirming the signal, and it's breaking out through this level, and it's telling us that our J-hook pattern is in progress. So this is nothing more than recognizing what patterns usually occur in investor sentiment. Hey, Matt, a while back, there was that slow curve with a Doji right here on the resistance level. The next day, they opened a positive. This created a very strong price move after that. Just made huge amounts of money, both in stock and calls. Just this with this slow curve breakout tells you there's a new dynamic coming into the stock. Downtrend, bullish engulfing, right smack dab on the 50-day moving average. Gap up, breakout. Do we always get moves like this? Not necessarily, but there's a huge percentage of the time that we're participating in a big breakout situation. Notice the Doji gap up, your best friend. Stochastic's moving up, breaking out through the resistance level. Then you've got what we call a double Doji. It's kind of consolidation. Open up positive the next day. You want to be a buyer because it's telling us they're moving positive, which means they're breaking through this level. So if we see something like this, we're looking for positive trading. That's when we start coming in and buying because what's going to happen? Either it's going to fail right here or it's going to have a big price move to the upside. This is where the big price move potentials were. Doji gap up. Then once we see a gap up in the overbought condition, again, that comes back to the very basic premise of where do most people buy? They buy enthusiastically at the top. So anytime we see a gap up in the overbought condition, we're getting ready to take profits. We have a little shooting star, bearish Harami. We're taking profits because where could it possibly go to? Back to the T-line. We can always buy if there's a buy signal off of there. Now what we can see is that this fry pan bottom setting up, we're just going to watch to see once it gets back up to this level whether it breaks out or not. Doji gap up, we're right about at this level, about ready to break out. We're buying based on the fact that if they break through this level, we've got wave 1, fry pan bottom wave 2, going into wave 3. YY not too long ago, fry pan bottom, they gapped up through the resistance level. So you got to basically tell yourself, is this resistance level going to be in progress if they gapped it up through that level? Well, everybody and their brother, you don't have to be a technician to know that if it breaks out through a resistance level, it's going higher. They gapped up to go through that level. We're buying immediately. There's our strength with the gap up through the resistance level. This was on Wendy's, anticipating more upside. So again, the Doji rule, there's that, what we call our Flutter kicker, a down day. right on the 50. The next day they gap it up and do a doji. Not very convincing. Makes it easy though. If they open up positive the next day after a doji, they're going to go positive. If we took out this doji, you essentially have a bullish kicker breaking out through this level. It's going higher. There's your flutter kicker through a resistance level. Tells us we're still in a strong uptrend. Doji sandwich. Big bullish day. Doji, they gap it up. You're going to have another big bullish day. Tells us, again, we're in an uptrend. Our stochastics are still moving positive. These are all just examples of the doji sandwich breaking through resistance level. Here we have a doji sitting right smack dab on that resistance level, the 200-day moving average. Stochastics heading up. Very simply, if they open up positive, which way are they taking it? They're going to take it positive. And if they do a doji sandwich, same magnitude as that day, we can pretty much calculate, even on a day trade, what our target is. They're probably going to take it up to the 50. At that point, we don't even see a sell signal yet. If they'd open it lower and start trading it down, that would have been a bearish Harami. We would have closed out the position. Breaking through on a doji sandwich, not only through the after a doji of positive trading, but through this resistance level and the 50-day moving average. Everybody and their brother who's usually trades off the 50 is now buying. We just happened to be in there early. We had a flutter kicker signal, doji sandwich, breakout through the resistance levels. We're still going higher on that one. Game plan, very simple. If they open this positive and take it through this level, we're buying immediately. If we're owning this stock, if they open it lower, very simply, which way are they taking it? If they open it lower, they're taking it down, which tells us this resistance level acted as resistance level one more time. The double doji, very simple. It's just consolidation, but it's telling you the consolidation is not very convincing. If you see a doji, and they open up positive the next day, you want to be buying immediately. You're usually going to get the same magnitude move as prior to those dojis. Doji sandwich, or a double doji, just continues your uptrend. Doji right at a resistance level. Positive open, they're going to take you higher. So the breakouts are pretty much easy to identify or utilize using candlesticks. There's our doji gap up. That's definitely a breakout of this indecisive trading. What do we want to see the next day? Bullish trading. But they open it lower and take it down. So we can pretty much assume there's profit taking going on. Next day they open it positive. Where do we want to buy? We have our buy stop right here at the previous day's close on this close. Because if they can take it back up through this level, that tells us immediately the profit taking's over. The bulls are back in control. We can see this graphically. When they gap it up and they start moving it positive, you can see another green candle forming. You get ready to be buying at this level because that tells us there's still a lot of strength in this price move. Breakout, gap up. This tells us that something new has happened in this in the perspective of this stock. Strong price moves. What do we do? Notice we've got kind of a little scoop pattern, which is one of the stronger patterns. It breaks out through this level, comes up, does a bearish engulfing signal, but or a bearish, dark cloud. But what we've been adding recently is the T line, as long as it doesn't close below the T line. But if it moves a good distance away from the T line, we throw what we call the 3T line on here. Now the 3T line is more effective because we've even moved away from the T line. So as long as it can't even close below the 3T line, we know we're still in an uptrend. This is what we're looking for, is those breakouts. This is not rocket science. This is just knowing that if this is starting to set up and we get ready through a positive trade with a doji gap up, your best friend, and then they take it right up to this level, we know very simply if they open this positive after this move here, they're going through. We've got a wave 1, wave 2, wave 3. It also helps us project trend direction. Trend direction. Now, we recently put everybody kind of comes in and shows you all the great trades that they made or can make with this program. Same scenario here. This is a nice buy signal on BOMT that about a week ago we recommended that it can be bought, except it didn't move anywhere. And then when it closes back below the T line, it told us to be out of this trade if we weren't out over here. Because if this was our buy signal, what should it be doing from here? It should be going up. Now it's moving flat indecisively. We're at the point now where we just recommended going short on this, because essentially what you have is a wave one, a dumpling top, and that means we could have another strong move to the downside. So there are times we get in, and then it tells us when to get right back out again. So if you're going to be a successful trader, you need to know when to cut your profits or cut your losses short, because that's the whole point of investing. Every trade's not going to work. When it doesn't work, you need to know when to get back out of it. Here again, here's RMTI we made a lot of money on, because there's your fry pan bottom, there's your cup and handle, there's your Doji Flutter kicker, that if it opened positive the next day, you want to be a buyer, because if it moves up through this level, you're breaking out. Do we always get moves like this? No, but we take them when we get them, because we're in the position of trading those. So do we close the trade? As you can see, this yet has not, or did not close back below the 3T line, let alone the T line. This was not too long ago on HIMX. Same scenario. We noticed it was staying up above the T line. We were buying right here on this little gap up that was sending us through this level. Notice how prices move in waves. Wave one, wave two. Now we have a kicker signal to the upside. We made very good money on ZLC, Zales, not too long ago. RPTP, again, there was a left-right combination that started the uptrend. There was our belt hold that told us the profit taking was over. That if you didn't catch it here, you could catch it right here, because we know what our next move should be. The same magnitude as that move right there. We're looking for something that's telling us it's time to be buying. There's your Doji or your Flutter kicker. A down day, a gap up. Anytime we see a gap up above the previous day's trading and does a Doji spinning top, we're looking for a positive open the next day to be buying immediately. Uptrend, fry pan bottom, breakout. Where does this tell us our potential is? To come right back up to the trajectory of that uptrend. So this creates a very quick price trade move. This was the Dow pattern a while ago. After a downtrend, notice what we had. This is what we call a cradle pattern. There's the headboard, then you have your flat bed, and there's your footboard. This is kind of the cradle hanging down between two trends. This was today, UNXL, a bullish Harami right on the support level. You can see it's supporting in here. And then they do a gap up through the T line. And there's another simple truism. The bigger the reversal signal, the higher the probability investor sentiment has changed. This one is going to be recommended as a buy tomorrow, anticipating our next target is to the top of the trend channel. ASNA today, gapped up. Where did it come from? Coming out of this fry pan bottom. So the fry pan bottoms, the patterns we're looking at because they do produce very strong results. And another good thing about a pattern is that the pattern is usually created by investor sentiment based upon something that's going on in spite of what the market trend is doing. So that means that the market is soggy, as we've seen in the Dow here for the last week or so. This didn't have anything, it wasn't influenced at all by what the Dow was doing. It was still producing its own pattern because something was going on. So trend analysis is very simple. Here's the Dow. You can see down here they did Doji hammers. You can see up here, this is where your shooting star sell signal was. There's your bullish Harami. There's your hanging man, confirmation back below the T line. There's your cradle pattern, started your uptrend. Layer 2, right here at the top of the trend channel, we call this all the sell signals away from the T line. We're in a downtrend, obviously, on the Dow. Where's that going to take us to? Could take us back down here, could support right here. The nice thing is we can project where it might be going, but the candlestick signals tell us exactly what happens. If we happen to see a big hammer here and then positive trading the next day, that tells us the 50 was acting as support. Now, we can make our analysis of how we should have positions in our portfolio based upon we want to go with the flow. Usually, you're going to be able to analyze that the indexes are moving in the same direction. But notice how the Dow is trading off. At the same time, the NASDAQ can't even close back below the T-line. So we're still in an uptrend on the NASDAQ. We're in a downtrend in the Dow. So it becomes a little bit more exaggerated right now that we're heading nowhere, that some sectors are heading up, some sectors are heading down. Also, the nice thing about candlestick analysis is in less than 10 minutes each day, less than 20 minutes each day, you can identify which stocks you want to be short. So in a market like this where you've got some sectors heading up, right now we're short SA because of a bearish engulfing signal. And we can observe the obvious. The obvious was we're on a downtrend, came back up, did a bearish engulfing signal back below the T-line. We were shorting it here. At the same time, I saw somebody ask about Taser just before the presentation. There was your buy signal, a Doji gap up through the T-line. Doji gap up. Right now, we're not even below the T-line. We're in an uptrend until we see a sell signal and a close back below the T-line. So this puts us in a situation where we can analyze how much we want our positioning in a portfolio, that sometimes we're going to be basically long, sometimes we're going to be basically short, and there's other times where we're going to have 50% long, 50% short. But again, the simple scanning techniques of candlesticks puts us in a position where we can see which stocks are heading higher and which stocks are heading lower. So if the market's moving sideways, we can still be half long, half short and making money in this market. So that's about all I've got. Again, I've been trying to teach people candlesticks for years now. And what it boils down to is most people say, oh, there was too many of them to learn and they didn't always work. And I always came back to one simple premise. If they didn't work, we wouldn't be looking at them 400 years later. There's one simple rule on Wall Street. If something doesn't work, it's gone fast. So what we do is we have what we call a 12 for 12. And that is that we're selling our package of 12 major signals, which I spend about 45 minutes on each signal going through the details of how it's formed, what the psychology that formed it, and what the what confirming indicators help improve the probabilities of being in the right trade at the right time. And with that, let's see, oops, I'm trying to put the, well, this is the link that for those 12 major signals, that usually retails on our site for $581. You get that for 12 buckaroos. That's less than 2 Starbucks coffees. But wait, there's more. Plus, you get an option to take a 30-day free trial to our membership area. Now, my website is candlestickforum.com. What we have in there is a membership is that each Monday and Thursday night we do a session on training people what's going on in the market, which sectors or which indicators seem to be working the best. During the day, we have a chat room that usually has about 230, 250 people in it, in all levels of learning how to use candlestick signals. So it's a great place to ask questions for identifying the signals. And each night I put out 2 or 3 picks, not so that people have stock picks, but I do it in a video format so they can learn how to use those signals correctly. And I don't like to tell people what to buy. I like to have them learn what they're doing. If you tell people what to buy and they aren't knowing why they're buying, it doesn't do you any good. It's like the cop that's standing on the street corner and he sees this guy driving down the street, weaving back and forth. He blows his whistle, pulls the guy over. The guy's drunk, walks up to his window. He sees a penguin in his back seat. He goes, "What the heck are you doing with a penguin in your back seat?" He goes, "Oh, I found him out on the street, and I don't know what to do with him." And the cop said, "Well, take him to the zoo." And the drunk said, "That's a good idea." Well, the next day, the cop's sitting on the corner, and here comes this drunk weaving down the street again. He blows his whistle, pulls him over, walks up to the car, and sure enough, there's the penguin sitting in the back seat. He said, "I thought I told you to take the penguin to the zoo." And the drunk said, "I did. He liked it so much. Today we're going to a baseball game." So if you don't know what the signals are telling you, and while you're looking at it, it doesn't do you much good. So for $12, you get a package worth $581, plus you get 30 days free trial to our website. During the month, we usually do two or three, up to 4 training sessions for members on how to scan for the best signals, how to use or how to have effective entry and exit strategies, how to set your stop losses. These are all about 1-hour tutorials that we do live on a Tuesday or Wednesday night. We also do it for option trading, how to set up your option trades based upon the specific candlestick signals and patterns. So, again, that's all. I guess there's the link that Herbert has put in. If you click on that link, now, we're not trying to trick people into becoming a Candlestick member. After 30 days, you're going to get a message saying, "Do you want to continue? Our membership is $97 a month, or do you want to opt out?" So it gives you an opportunity that if you didn't like what you saw or you didn't have time for it, you can click and opt out. But our modus operandi is that we give you a ton more information than you expect. And the one nice thing about candlestick analysis is no matter what training or what trading method you're using, if you use candlestick signals on top of that, it's going to make you see your trades a heck of a lot more clearly. So, Herbert, that's about all I got. If there was questions, I'll be glad to stay as long as we answer all the questions.
All right, let's do some questions here. So, number one question that I fielded while you were going through your educational material is, what is the T-line?
T-line is the 8 exponential moving average. Now, why does the T-line work? That we don't know, but we think nobody uses the T-line, or very, very few people use the T-line, the 8 exponential. We figure it's somewhat along the same lines as a Fibonacci number, which is just a natural number that seems to work. And so the T-line, and I tell people, test it. Throw the 8 exponential on your charts and see if the trend didn't stay above the T-line until it was time to sell, and vice versa. That you could go short until you saw a buy signal and it closed back up above the T-line.
Another question is, when I order the 12 for 12, do I get DVDs or is it online video?
Online. You'll immediately have a link where you can download all the information right onto your computer.
Let's see here. What screening software do you use to pick up the signals and formations for the J-hook and frying pan bottom?
All those formulas are on our site. I think we've now got up to close to 1,300 pages of information on our website. A lot of it is for the members area, but we have the formulas. Plus, I use softwares like Metastock. I've written all the scans for Metastock, Warden Brothers 2000, and you can use it for if you're using things like TradeStation. I thought TradeStation was going to have me write their formulas here in September, but we haven't heard back from them. And TC, or not TC, not Thinkorswim, also has quite a few of our formulas over there on their softwares.
What numbers do you use for your slow stochastic?
12-3-3. And that's nothing set in stone. It's just through the years I kept tweaking it, which I say through the years. It only took about 30 minutes to tweak it to find out where the the bottoms kind of coincided with buy signals at the bottom, and where the sell signals coincided with the tops.
Okay. What is the 3T or the T line 3? Is there a 3T line, or is it?
Yeah, the 3T is the 8 or the 3 exponential moving average, and we're in the process of testing that, which we've pretty well tested it, but it works very efficiently when you've moved away, when the price has moved so fast that it's moved away from the T line, that you can use the 3T to, if you see a sell signal at the 3T away from the T line, then it's time to take profits, because more than likely they're going to come back and test the T line.
One person says when I order, I didn't get anything. Just wait, you'll get an email confirmation. Sometimes it takes anywhere from 2 or 3 minutes up to 15 minutes. So anytime somebody blasts an order on a shopping cart, sometimes you'll have a few little bugs. So just give it 15 minutes.
Yeah,
and you'll love this one here. Jerry says this guy is better than Steve Nissen. Steve Nissen is a jerk.
Well, I tell people I don't want to judge anybody else until I've walked a mile in their shoes, for two reasons. Number one, if I say something that pisses them off, I've got a mile head start. Number two, I've got their shoes.
Yeah, exactly. So are there videos or PDF files for reading? I just want to clarify.
Videos. You'll get a 45-minute video on each of the major signals, and it goes through in detail what the psychology was that created that signal, what the signal looks like, where does it occur, and what confirming indicators improve the probabilities of that reversal occurring.
So, guys, in the chat box, I have posted you a link. It's too hard to say because it's a long link. So if you just click on it, you can go order it. Stephen Bigalow is reliable and straightforward. I agree. Does your screener work on toss? He already answered that. Most of his screens are in toss. I missed the presentation. Is it recorded? Yes. No promises that you'll get it because sometimes the recording messes up. But yes, we are recording it. Do you recommend daily charts for most trades versus 5-minute trades?
It all depends on what type of what your trading style is. I used to trade the E-minis, and I'd use the 1-minute, 3-minute, 10-minute combination. If I'm swing trading stocks, I'm using the 10-minute, the hourly, and the daily combination. If I'm trading commodities right now, which I usually do, soybeans, cattle, the U.S. dollar, I'll use a combination of the 10-minute. And what I use the 10-minute for is that becomes my bellwether. If it looks like something is setting up for a reversal, then I flip down to my 5-minute. If that's improving or confirming the 10-minute chart, then I flip down to the 1-minute chart to tell me when it's exactly time to get into the position. Now remember, each time frame is the accumulative knowledge of everybody buying and selling during that time frame. So, and it's not very hard to pick out a combination for whatever you're trading. If you're a day trader, you're going to use much faster charts. If you're a swing trader, you're going to use maybe the 10-minute, the hourly, and a daily chart.
All right. So more questions here. Thank you for the amazing PowerPoint presentation. What other MAs do you use?
Those are it. The 200, the 50, and the 20 are your simple moving averages, again, because every major money manager around the world makes their decisions based on those. Then after that, it's the T-line and the 3T. And then on my commodity charts, I've got the 34 exponential moving average, which works pretty good. It's just not as as active or isn't used as often. Now, the 20-day moving average isn't used quite as often, but the 20-day moving average on most stock charts become in effect once there's a trend that's been in progress for a while and they don't pull it back to the 50, they'll usually pull it back just to the 20.
Okay. How long will I have access to the 8 hours of training? Also, is the information downloadable?
Yes, it's downloadable, and once you download it, it's yours forever.
Okay, let's see here. What studies are on TOS? We've already answered that. How long is the course available to buy and the link after we buy? Well, I mean, the deal that we're offering you today is good for today, and we'll probably send out a reminder, but You know,
Yeah, you probably have a couple of days. Again,
yeah,
yeah,
he's not going anywhere, guys.
yeah. And number two, we're trying to make it so simple that
Yeah,
for $12, as I say, you can't even buy 2 cups of coffee at Starbucks for that. For
yeah.
$12, you're going to have at least 30 days free website participation, as well as $581 worth of information. Um, let's put it this way: you're not going to feel like you've didn't get your money worth out of this. The reason we're making this so strong is that most people know about candlesticks. They think they're too hard to learn, but if you just once you learn them, I mean, I've tried to simplify everything for trading, and all it is mere common sense put into a graphic depiction. Once you have that and you understand it, you're going to be able to trade any market, any time frame you want to, with any trading method after that with much more clarity.
All right, so I just want to be clear. I'm getting a few questions here. So the $12, you get the course for $12, guys. If you're struggling over decision over $12, you really shouldn't be trading. $12 for a really, I mean, that's 2 round turns on a trade for real. $12 is not a lot of money. I don't care who you are. I mean, I'm not saying $12 is no money, but for information that can help you trade better, even if it just helps you with one trade, it's $12. Now he's also got, like, after you go through the $12 course, you also have the ability, if you want to, you can upgrade to his membership site, which I believe is $97, and that gives you 30 days to try that out. And before they bill you, they'll ask you if you want to continue and stuff like that. So it's a no-brainer. You should definitely do it. I mean, for $12, you're getting a lot of really good quality information, which is straightforward, easy to understand, and you'll have some good knowledge on how to use candlesticks. Okay. And like I said, the way that Steve Nissen presents the information, and I don't want to talk bad about either one of them, it's just a little bit more eclectic, a little bit more esoteric, a little bit more confusing. The way that Bigalow does it is it's straightforward, to the point, and you understand. It's like a recipe. You're like, oh, that's a pattern that means it should go up, and if it doesn't go up, then I need to get out. So take an opportunity to sit here and click this link really quick. Fill out the information, whip out your credit cards, get your credit card out of your pocket or out of your wallet, and put your credit card information into the order page. It's $12, and it'll be a really good value for $12. You can't go wrong. How long will it be available? We've already answered that. Do you teach how to use the setup as your trade entry, then to exit when another setup happens? So in other words, in your course, are you teaching them entries and exits with candlesticks?
Exactly. Yes, that's the whole point of this. Is you've got good candlestick buy signals and you've got good candlestick sell signals. So my basic rule is, if I see a candlestick buy signal in the oversold area, I'm going to buy, hopefully for that confirmation that it closes above the T line, and I'm going to hold it until I see a candlestick sell signal and a close back below the T line. So
Scooter says, I have taken the 12 candlesticks course and really liked the education. Thank you, Scooter. Appreciate it. There's another question here. Can you still let me see here. Can you still use the candlestick signals even if I don't have any of these platforms that you talked about?
yes, whatever charting that you have, once you identify the signals on any chart, you don't have to necessarily know how to scan for them. All you have to do is visually identify them. Because if you see if you've got your chart set up where your stochastics show an oversold condition, and you see a doji being confirmed, you have an extremely high probability you're going to be in the right trade at the right time. So the answer to that is no. You don't have to have a scanning software. You can have any charting, whether it's with your brokerage firm or any charting. Free, I think Big Charts is free, and there's a few other free charting services out on the market.
So, Abraham, for your question, just call their office tomorrow, and they'll help you out with that. I joined late, but it looks like I have added some new techniques. Does the educational material contain updated techniques?
No, the material. Oh, you're going to get a lot more information on the website and the chat room. Unfortunately, there isn't no. That's not the right phrase. There
I,
isn't
I,
any.
I would no, I would say it that way. There ain't no more updated information. It sounds
Yeah,
way better.
that this is the information that has worked for 400 years. Um, it's yeah.
It is. It's one
All
of
we're trying to do is teach people how to use these signals correctly.
it's one of the most frustrating questions you get when you're a trader, and then you get into the education business. Like, well, what's your new stuff? You're like, what do you mean my new stuff? This is the stuff that works for me.
Yes.
Yeah,
Yep.
it's a frustrating question. This is incredible. Thank you very much. How long will it take? Oh, we already got that one. Got that one. I ordered plus upgraded. Thank you very much. Appreciate that. I'm sorry I missed the 3Ts. Is it at 8 MA? Yeah, the first the T line is an 8 MA.
Yeah,
Sounds
and then
good.
the 3T is the 3 exponential moving average.
So there you go. So we're going to open it up for questions for just a few more minutes, and then we're going to let Bigelow get out of here. Because I know he's a little bit under the weather. I appreciate you hanging in there, man.
Oh, no problem. I'll just keep drinking my Dayquil and my scotch.
Oh, nice, nice. Oh,
Any other questions?
I think that's it. I think we're all done.
All right.
Someone asked you, why do you trade more futures than stocks?
Because I don't trade more futures than stocks. I just trade. I usually trade the first 45 minutes of the day is when I establish my stock positions. After that, I would say that 80 to 85% of my trades are done within the first 45 minutes. 10% of my trades are done in the last 20 minutes of the day, and 5% of my trades are done during the day because there's usually nothing. The information going on during the day is just noise. It's because the Japanese race traders boxed in the open and the close. The close is your final decision between the bulls and the bears for that time frame. So anything else during that time frame is just kind of noise. So I don't really have to do a whole lot to do during the middle part of the day. Well, the commodities open up about an hour after the stocks do, and they close about an hour before the stock market. So if I've got some trades or I've got my commodity account, my bigger accounts obviously are the stock accounts, but then I trade commodities during the middle part of the day when there's nothing going on in the stock and that I'm going to make any decisions in individual stocks.
Thanks, Steve. Appreciate your time. Have a great night. I enjoy the 8 hours of trading. Hubert, how do you see using this material in the Hubert trading world? So, Tony, I've been using candlesticks forever, and I use his methodology. So, I mean, a lot of the stuff that I do with candlesticks is you get to a level to where you've been trading so long that it just gets to be unconscious competence where I'm like, oh, that's not a good thing. That's not going to continue. Oh, this is a good thing. This should continue. So you'll get really, really attuned to being able to read the candlesticks. I will tell you that for me personally, I like using them on longer time frames like daily, 60-minute, 30-minute, 15-minute. Below 5-minute candlesticks, for me, they give me too many signals to be really valid just because there's so many of them. So,
right, and I use only the 1 minute chart to when my 5 minute and my 10 minute are confirming that there's a possible reversal. Then I'll flip down to the 1 minute, and then I can actually see my actual what's going on right at that moment. That if the 1 minute is confirming what I suspect the 5 minute and the 10 minute are telling me, then I just use that for my execution, not for my analysis. The 10 minute is mostly for the analysis. The 5 minute and the 1 minute are for setting up your best entry and exit strategies.
Cool. Are there PDFs along with your training?
Yes. There we've got, I'm guessing somewhere around 40 or 50 videos and ebooks on our website. So all you have to do is go to our products and services and pick which format you'd like to use the best.
Steve probably doesn't use Heikin Ashi charts, I bet, right? I don't know if he does or not. Do you use any?
I helped set up some of the studies of that, but the Heikin Ashi charts are kind of a lagging indicator. They're kind of smoothing out the trend. I've used everything. We've had John Bollinger on with his Bollinger Bands, Dave Elliott converted the Bollinger Bands to Mobo Bands. If you use the 8 exponential moving average, the T line, you'll find that's probably as efficient, the most. Now, I say it this way: I have found it to be the most efficient trend analytical tool that I've come across in the last 35 years. Heikin Ashi is more of a much longer term, and it kind of, again, kind of vanillas out the trend. So yeah, it's a lagging indicator.
I would definitely agree. I mean, because what it's doing is it's taking 6 bars average, and you're going to have a 50% close above or below. It's a good trend identification tool, but it doesn't trend change. It's not the quickest thing in the world. So yeah. Let's see here. Do candlesticks patterns work on all time frames? So we already covered that. Will this be helpful for options traders?
Yes, definitely. As when I showed you some of those slow curves produce huge profits because it basically tells you when a strong price move is going to happen. Number one, the magnitude of the move, and number two, the timing of it. So basically what candles, if you ever hear somebody, and this is not unusual from most money managers, they say, you can't time the market. You just have to buy good quality positions and hold on to them. Stay away from them as much as possible, because if you couldn't time the market, we wouldn't have names out there like Warren Buffett and George Soros. They know how to time the market on a much longer term basis. Candlestick signals just help you time the market on a very short term basis.
So Bruce says, I'm having problems getting through for some reason. Can I call that number at the bottom of your page tomorrow and get some help?
Yes, and or email Abraham at candlestickforum.com.
There you go. How are candlestick patterns for the Forex market?
As long as you can find where your time frames open and close. I mean, obviously, with it being a daily continuous trading, you don't have your daily charts. But if you use a 10-minute chart or an hourly chart, depending on the speed you're trading, yes, they work just as well on Forex as they do anything else. Remember, it's the cumulative knowledge of everybody buying and selling a specific entity at any time. So anytime you've got fear and greed, which is all trading entities, it'll work for it.
Can you repeat the email address? I think it was Abraham, but repeat it for him real quick.
Yes, Abraham at candlestickforum.com.
There you go. Okay, let's see here. I signed up, but I got a message. Oops, looks like there's a problem. Yeah, just call the office tomorrow or Abraham at candlestickforum.com. They'll help you out. If you're getting errors, all it really means is all of you are trying to order at the same time. And anytime you get several hundred people trying to order at the same time, some servers just bog down and you get these little glitches and errors. So if you just wait just a few minutes there, place your order. You can call them tomorrow on their office line. It's on the bottom of the order form. Or you can send an email to Abraham at candlestickforum.com.
Right, and there's another address right here on the page. If you do it to admin, Abraham gets those also.
There you go. All right. Any other questions, guys, before we take off? Where is the order form? All right, so the order form, if you look in the chat box, there's a clickable link that I'm sending to you right now. And I'm also firing off to you right now in the other chat box. So you should be able to see it. Great webinar. Thank you very much.
Well, thank you for having me.
Go relax, man. Go get better.
All right. Everybody have a good evening. Hopefully we'll see you in the chat rooms.
All right. Talk to you later.
Thanks.
All right, gang. So make sure that you take Stephen Bigalow up on his offer. It's a really good deal. 12 for 12. You're going to get some of the best trading education on candlesticks that's out there that's really simple to understand. There's a lot of candlestick information out there. It's just so convoluted and it's not really clear cut. So make sure you go do it. It's $12. It's going to be a great deal. You're going to learn a great deal of information. And then I would take him up on his 30-day trial and learn as much as you can from him. And if you like his stuff, stick with him as long as you can. If you don't like his stuff, then after the 30-day trial, he's not going to care. There's no hard feelings. He's going to be like, hey, thanks for the trial. Same way that I do it at my membership site. Hey, thanks for giving it a try. I appreciate it. Wish you the best luck in the world. So how about the bond trade? The bond trade, let me see really quickly. I am down 1 tick on the bond trade. that I did when we first started this webinar. I'm down 1 tick on it and 1 tick only. So that's where we're at with the bond trade. I'm going to be staying in it overnight. So I've got 4 more ticks to go before I get stopped out. And then I'm still holding for $1,000 profit. So good luck. Hope it helps. Any other questions that I can answer for you before I take off, I will do so. But make sure that you go over and buy his educational material for $12. What is the bond trade? I am long 30-year bond at 131 and 7/30 seconds. Thanks, great. Thanks, great help for us. You're very welcome. Thank you, thank you, thank you. You're welcome. It's my pleasure. It's why I'm here to serve you. Help you get some good trading education information out there. So hopefully you understand a deal when you see one and you take advantage of it. So good luck. Hope it helps. I will see you on the next webinar.
The organizer has ended the session, and this call will be disconnected. Goodbye.